Welcome to the Startup Grind.
And I thought I had a tough travel story from New York, and fraud gets up and says 39 hours. But I had a terrible Super Bowl to watch, so I think I win.
I know, he was there, like on the field. Isn't that terrible? It's great to see everyone. Hope you're having a great time. Like Fawad said, I was one of the first chapter directors outside of Silicon Valley, and someone asked me yesterday why I do this, and I do this because I get to interview amazing people like Burton Goldfield. Today's topic of conversation is about value, and speaking of value, TriNet is going to be IPOing, and they had $1.3 billion in revenue in the first 9 months of last year. So everybody take that in for a second. How many of you have heard of TriNet? How many of you are customers of TriNet? I think more people should be customers of TriNet. Okay, so let's get started. Burton, thank you so much for being here. I'd love to start with talking to you about a little bit about your background, but also as some of the things that define you as a CEO.
So I'm born and raised in Philadelphia, graduated biomedical engineering in the early 70s, and there were no jobs in biomedical engineering, but I could program in an amazing language called COBOL, which gave me a great living to earn in the early days. Realized that if I was going to be in software, I wanted to be very near where it was all happening, which was Palo Alto at the time, the HP garage. So I flew out to California, and I walked past the garage on Addison. For those of you who don't remember, HP was an amazing company at the time. You can argue that at this point. That's a different discussion. But Bill and David built an amazing company. I looked at the garage. I started circling until I found an apartment, and I said, I want to be part of this. So timing is everything, and it was an amazing time to get in the industry. So what was your second part?
What do you think are some qualities that define you as a CEO? You've had a long career in running and building companies, and just to start off about you.
So I think the first thing is persistence. I'm still here, which is a defining factor after a lot of years, and I think that that's very important to have a vision that you believe in and just keep fighting. And then the timing is right, and it happens. So I think that's number one. Number two is about building an enduring company. I had the fortune of living through the dot-com boom here in Silicon Valley, where if you had a pulse, you were made a VP and got $4 million worth of options. Of course, those options were worth 4 cents in the year 2000 when the market crashed. I was the only one in Silicon Valley at that time that cheered on the market crash, because even though you had money, you couldn't get into a restaurant, and your money didn't do you a lot of good because you couldn't drive down the highway. So a lot of people who thought they were really, really good, it was a life-changing experience. For me, realizing that I was never that good, it was a great moment because it validated a set of philosophies, which was, if you build an enduring company over time, you can be successful. And at that time, I was with what was considered an old stodgy company called Rational Software.
I want to stop you for a second. How many people have heard of Rational Software? Okay, that's actually a good amount of people. How many people have heard of Pets.com? Okay, so we're going to come back to that point right there. But just to kind of get a sense of, people have heard of Pets.com and it's gone. And Rational Software is this company that is actually still inside of IBM and talking about building value. Tell us about your story with Rational.
So the interesting part of that story, great company, great group of people, great culture, but we lost about half the company to the startups in the startup boom, in the dot-com boom, and every day it was a joke because a meeting would come on your calendar and it'd be somebody else resigning. And it was a daily activity where somebody would resign every day, say, look, I'm going to an amazing company, I'm going to Broadbase, I'm going to Kana. The stock went from 0 to 200, it's going to 250, and Burton, no offense, but Rational was an old, stodgy company. We were 4 years old at the time, and we were doing about $300 million in revenue, growing at about 20%, with profit margins of about 22%. And of course, all these other companies were going at thousands of percent, and they had no profit, of course, and people left. And the lesson I learned was when we went to sell to IBM, which was in the year 2002, we sold for $2.2 billion in cash, and about half the people that I wish were at the table to get paid off were not there because they had taken the stock that rose to 200, and I think Broadbase got to $242 a share before it went to zero. They had taken that stock, they left, and they got nothing. And it was a shame because if you look at some of the core early developers that made Rational a great company when we sold to IBM, they weren't there at the table, and ultimately everybody who stuck with the vision believed that we were actually doing something worthwhile and didn't get waylaid by the shiny object, ended up making a lot of money.
So let's talk about the shiny object a little bit and kind of how that relates to now and what is valuable and how that relates to valuation. So, right, if we look at Snapchat, for instance, because I'm a huge fan,
right.
And not really, but really, they say it's valued at $4 billion, and Mark Andreessen has come out and said something like it could be worth $100 billion, and versus a company like TriNet, which has $1 billion in revenue. Like, how do you look at value and valuation?
So does everybody realize that every question she asks is about 5 questions?
I like to give you room to move.
So a couple issues. One is, to me, as a CEO, and to the CEOs in the room, value is what you want to create. Valuation is what investors put on your company. And never mix the two up because they are very, very different. And as you build a company, it's important to make sure that you have your perspective, your investors have their perspective. They may be the same or they may be different, but at least understand where you stand on that issue. It's a tremendously important issue, particularly as you get bigger. In my situation, as was mentioned, we filed for our S1. We have an intent to go public in the next few weeks. To me, that's just an event. It's not a big deal. What's a big deal is building an enduring company over the next 10 years. I won't sell a single share of stock. I believe that the value of the company to me is very different than the valuation we get at an IPO. I believe that building an enduring company, finding 4,000 to 6,000 more people who want to come along and be part of that mission, is the value to me. The valuation, which is a very important aspect of this, is if you're an investor, there's a different emotional attachment. You guys, as CEOs and gals, get to have fun in building value as you define it. People ask me, should I take startup money? Should I take VC money? I'm owned by a private equity firm, wonderful firm, General Atlantic Partners. They have their own valuation for TriNet, and they will get out as they choose to. And my goal is to continue to run and build a great company that's creating value. And to me, value is helping startups, getting people back to work, being part of the success of growing companies, and interfacing with incredible entrepreneurs that are absolutely changing the world every day. So the value to me is not a monetary value. Now, I can say that because I exited from Rational. It's not bad to put a financial number on it, but for a CEO, the value of the company is far more than a valuation set by your investors, by the market, or by whatever other circumstances drive the growth or success of your company.
So, what advice would you give to early companies about kind of setting a roadmap around creating value and understanding what they want to in terms of creating value? Because there seems to be a lot of people chasing valuation.
Right. So my advice is, and there's nothing wrong with chasing money or valuation. That's not my point. My point is, you as a leader, as an entrepreneur, as a CEO, whatever role you're playing in it, have to sit in a dark room and say, what am I truly looking for? Not what does the other guy have, or what plane is he flying, or why was it cool that he got this. What do you want out of the company or the creation that you're either leading or part of? So what would define success in your mind? And then don't change that very often. And don't revisit it very often. Revisit it every 6 months. If you revisit every day, it will drive you crazy. The market goes down, the market goes up. The overall stock market's going down, I'm buying stock. I believe that the overall growth of our economy is going to be phenomenal. Don't take that to the bank, but that's what I believe. I'm not looking to follow the trends in business or in the market as far as what the overall outcome is going to be. And as a leader in a small company, if you listen to the next VC, if you listen to the next private equity guy, if you listen to the next industry pundit every day, you will never be able to focus on what true north is for you as a leader or a CEO. So my advice is stick to it. The worst thing that's going to happen is you fail and then you do something else. There's plenty of jobs out there. We have 300 open jobs if you can't find one yourself. And do what you want to do.
Was that another hiring pitch?
So do what makes you happy and really not be influenced. And my biggest piece of advice is don't wish you were anybody else but yourself, because we're all fortunate to be sitting here in Silicon Valley today talking about amazing, fun, exciting, and mind-boggling issues like the ones we're talking about right now. So we've all won. You can declare victory. You've already won. Now go do something that's important, fun, and ultimately impactful in your mind, not in the mind of investors. So I have a bunch of investors that are all excited about the IPO. I am not excited. I want to do a good job. I'm going to do the best job I know how, and I'm happy that over time they can get out. That is what they do. As a CEO, you build a culture, you find great people of like minds that want to run through walls with you, for you, together, and try to do something really cool. If it doesn't work, you go back and start over. There's always a safety net. Everybody here can get a job. So, but I love talking to my investors. They don't want to be a CEO, and I would never be an investor. So we have different roles to play. They understand what I want to do with the company, and I talk about it openly and outwardly. The reason I took the job at TriNet was there wasn't an obvious acquirer. And you might think that's ridiculous, but I took the role because I had gone through selling Rational to IBM and Hyperion to Oracle, and I was known as somebody who could sell a company to either Paul Mazzano or Larry Ellison, and they said, take my company, pretty it up, put a new middleware layer in it so we can sell it to Microsoft.
So what's the difference in the experience of getting a company ready to be acquired versus getting a company ready to IPO?
Everything's different. If you're building an enduring company, you worry about who you hire. If you're building an enduring company, you worry about how you train people. If you're building an enduring company, you're worrying about the culture. You're worrying about the quality of the product. You're worrying about the relationships with the clients. If you're putting something up to be sold, you're worrying about maximizing EBITDA. You're worrying about making sure that everybody is on point of who's staying, who's going, and how you're going to transition this thing into an acquisition target that makes sense. As I said, and this is a few years back, it was all about switching out software so it would be more attractive to IBM, Oracle, or Microsoft. Those were the three at the time. This was before the Google days and a few other companies. But it wasn't, hey, this is the best software. It was, this is software which will be attractive to the acquirer. It was about building the channel. You want to maximize revenue, cut costs in your channel, and figure out, not maximize revenue, maximize profit, figure out how to get a multiple of profit and get the heck out. Again, not a bad thing, just a completely different strategy. There's nothing wrong with chasing that strategy and doing it over and over again. I'm not saying one is better than the other, but if you're asking about whether they're different, they're completely different. It's a completely different strategy, night and day.
So speaking of acquisitions, while your goal has not been to be acquired, you do make acquisitions. And we talked about that a little bit in our pre-talk. What do you look for in companies that you acquire? So
we've acquired 6 companies in 2 years. There's a couple of different types of acquisitions. The first thing I look for is a great group of people, because we need a lot more people. So I will not consider an acquisition where the team isn't excited about being part of the overall organization. We just just did 2 big ones, and we did some small ones. The most fun recent one was a company called ExpenseCloud out of San Diego. Great group of programmers, great group of individuals with a startup mentality, great UI capabilities, and ExpenseCloud fits very well in to TriNet because we generate the payroll. So anything that's wrapped around the payroll engine was important for us to acquire. So cash acquisition, everybody stayed. They make a little bit of money on the acquisition. They get stock and options in TriNet, and they get to roll their future with a company that's going public. Not a bad outcome, but if you're looking at the outcomes of some of these other companies of billions of dollars, it's not the same. So we found a group of people that declared victory by joining our team, taking some money off the table and being part of a much bigger vision, a much more well-funded operation, and ExpenseCloud's part of TriNet. So we're looking at technology. We're also looking at companies that can get us into markets we're not currently in today. So we did the largest one was a public company, which was a hostile takeover of a company called Gevity. Very interesting experience, great group of people that stayed, and the executives all left, and we were able to make that work over a couple-year period. But it took TriNet from being a Silicon Valley-based company to a company that was multi-coast. So we could go in, and now, when I was in New York City telling people we process payroll in California, we would have gotten a better reception by saying we process payroll in Havana, Cuba, for the East Coasters than processing payroll in California. So having an East Coast large-scale operation, which we got in the acquisition out of Florida, gave us that East Coast presence, so we could go national and be a much bigger company. So to me, you're looking for great people. You're looking for a significant strategic advantage. We have a sales force of over 500, so putting something like ExpenseCloud into the bucket of the 500 people in the channel we're working on accelerates their growth, gives us an opportunity to add more value to our current clients, and allows us to bring a culture which is radically different into TriNet to help morph it into to keep it a startup culture as we approach 2,000 employees.
So if you were going to give advice to someone who is, let me back up. Ellie, as a founder, like my worst nightmare if I sold my company was that like the thing that I built and value got shut down. And it happens constantly. So if you were someone who was considered or considering being acquired, and
right.
There's a lot of yes and no that happens. I mean, people say no all the time. What would you advise to a company to look for in an acquirer?
I would advise people to look for the same thing in an acquirer as you do in an investor. People make many more mistakes with who they take on as an investor than they do who they take on to acquire the company. Again, it's being open and honest about what you want and making sure that the person on the other side of the table really hears you and respects what you're doing. And as I said, you can have completely different goals and still have a great relationship with investors and also with acquirers if that's arranged up front. So
basically good communication
and knowing where you're at. And knowing, making sure you deal with great people. This valley is filled with amazing people who want to help, making sure you have the right mentors. And I have a going joke, if somebody gives me a name, I'm within 2 people of anybody. And if you're my investor, or I'm going into a meeting with you as a potential acquirer, I've already done a dossier that's 15 pages deep on the person I'm going to the meeting with. So having that knowledge before you walk into the meeting is really important because you know what kind of person you're dealing with. It's just such a small world that you can figure out whether that acquirer or that investor has flipped the company quickly, has turned on their CEOs, and you get to make that decision. You get to make the ultimate decision and either live with continuing to do it yourself or live with bringing on an investor.
I just realized I have no idea how much time we have. Can I get a time check from someone? Maybe? I don't know. Okay, I have 6 minutes. I think we should ask some questions from the audience. Does anyone have any questions for Burton?
Yes.
So is TriNet
Hang on,
profitable?
wait for the mic.
Is TriNet profitable?
Highly profitable, yes. So we, for those of you who don't know, with a public offering, below $1 billion in revenue, there's something called a quiet filing. It was put in place 3 years ago with the Jobs Act. We were above $1 billion, so I can tell you that we filed the S1. If you go online, you can see that we're highly profitable and we're growing.
So I have a follow-up question.
Sure. So yes, the answer to your
So
question is yes.
if you're highly profitable, what you say is basically confidence. When you're profitable, why go public and get the pain and the things that Wall Street throw at you? When you're profitable, use that money to grow. Why go public?
That's a great question. Anybody know the answer to that question? I have invested. Yes. What's the answer? Right. So the answer is that I am thrilled to go public or not. And as a CEO, you have to be flexible, but there's a lot of employees that have worked there for many years. There's investors who want liquidity on their stock, and this gives them that capability.
So at the end, it is money.
It's not for me. It may be for you. It's all good. I didn't turn it away when they sold the other two companies, but as a CEO, you have to balance what you're doing with the needs of everybody in that community. So on the margin, as a highly profitable, growing company in a decent market, there'll be a lot of people that are very happy, and I can continue as the investor base changes to grow the company in the way I want to. And if not, the alternative is to be sold to somebody else. So I want to be a strong independent company. Ultimately, I did not believe there was an alternative to going public that would keep me a strong independent company.
Thank you.
It's a great question.
That's a great question.
Another question.
Probably have time for like two more.
There's one.
Who's
Yeah.
going? Like,
How do you come to a price when you're going to buy someone?
So how do I come to a price? I have a great M&A team, and they look at it 5 different ways, and then we come to the price the 6 different ways, right? So I've bought pre-revenue companies, and it's been based on the salary of the individuals and what they needed to declare victory. Ultimately, you don't want to do an acquisition that's a win-lose. If it's a win-lose, you walk away. And I've never been in a situation where I had to do one. So if the founders and the team is not excited about it, we'll put it off a year, we'll walk away from it. I don't have time to tell all the stories about the early days with win-lose acquisition. They never work out, everybody leaves. So in the end, honestly, first of all, I've only done cash deals because I want the people coming aboard to have TriNet stock, not a payout based on what the legacy company did. I want them coming in and being part of a management team that's building a big, enduring company. So if you have this long payout based on the product, it doesn't work for me because the product at a couple $1 million doesn't move the needle on a couple of $1 billion. So I do all the standard metrics, and then we sit down and say, here's the standard metrics, what do you want? Give me your number. And ultimately, on that, we try to come to the right answer, and about 50% of the time, we actually come to that right answer. What I don't like to do is have long payouts. I don't like to have situations where that team doesn't come in and day one align with the big mission of helping small businesses succeed. You know, it doesn't matter, you know, when ExpenseCloud became part of TriNet, those employees are now TriNet. And they need to sink or swim based on TriNet growing profit and growing revenue. Because the problem with a business like ours is, as I tell my team, it's great that we're growing fast, and it's great that we're profitable, but it's not an and or. To be valued properly, you need high growth and you need high profit. And that's the holy grail of every business, and that's the hard one to sustain year after year after year. One more?
One more.
Here it is.
no pressure, it should be good.
Okay. You bought a cloud-based company. How do you think the cloud is impacting the operating model of the technology industry and software?
You know, coming from the classic software development world, it's just changing the cycle time on building products. That's simply put, you can leverage infrastructure, you can leverage freeware, you can leverage open source, and you can build really cool products really fast. And what I think the cloud has done is to consumerize the enterprise apps. Anybody who looks at some of the, the enterprise apps that are out there, they're horrendous. So you're seeing a big change in the enterprise world that you never saw before. We're in the HR space. It wasn't hard to build a decent HR app compared to what was out there from the old line companies that were doing HR. It just wasn't that hard. So I don't think we're that smart. We actually decided that we do something in a space that was relatively behind the time. So I do think the cloud and the open source opportunities create a baseline where in the past, with Rational, we start with a white piece of paper. We built, the entire app from beginning to end, and then we had a host. So I think it's a great future, and there's opportunity to create value very quickly. It's still not easy. There's nothing easy about it, but I think there's an opportunity to create real value in a short enough amount of time that the people in this room can do it 3 or 4 or 5 times, where I did it twice.
All right, I think that's it.
Thank you
Thanks,
all.
everyone.